So tax day, it's right around the corner, and it seems like this particular tax filing season has brought with it a pretty high level of confusion. Most of it due to the effects of the 2018 tax law changes. So here are 5 most common questions that we're seeing right now. First, what's up with the smaller refunds? This one's pretty easy to answer. So when Congress changed the tax rates, they also lowered the withholding table, giving people a larger amount of take-home pay. So in other words, you got your money during the course of last year instead of this upcoming month in April as a refund. Yeah, it's kind of sneaky, but that's politics for you, right? So the other question that we get is, why are my taxes higher? Wasn't there a tax cut? Yes, there was, but while tax rates went lower, we also lost some big tax deductions. So people who live in high tax states like I do here in California and also New York and several other high tax states are seeing higher tax bills because of the $10,000 cap on state and local tax deductions, which you'll see talked about in the media as SALT, state and local tax. And so for many people, this used to be their largest itemized deduction. So if your state and local taxes exceed $10,000, you can't deduct your property taxes anymore. And if you make between $200,000 and $400,000 a year, this probably hits you pretty hard. So this leads to another question. Should I take the standard deduction or should I itemize? Well, the standard deduction was raised this year to $12,000 for single filers and $24,000 for joint filers. So if your mortgage interest, your charitable deductions, your state and local tax deductions, and all that exceed your standard deduction, then of course you should itemize. Otherwise, no, forget about it. And here's a nice little tidbit for you. TurboTax says that about 90% of taxpayers will take the standard deduction this year, which is up from about 70% in previous years. So here's one that we get asked quite a bit. Is it true that alimony isn't deductible anymore? Well, it kind of depends, right? So under the previous law, if you paid alimony, you could continue to deduct it, and it was taxed to the recipient. So this still holds true unless your divorce was finalized, say, this year on January 1st, 2019 or later. In that case, the payments are no longer deductible, but the recipient also doesn't have to include that alimony income on their tax return. Think about that one. That might be a little bit interesting. Okay, and finally, you might be asking which deductions may have changed or even gone away. Well, for example, the dependent exemption, that one's gone, but it was replaced by a higher child tax credit. Mortgage interest, well, for loans that are taken out after last December 15th, the interest deduction is now capped at $750,000. How about moving expenses? Well, only members of the military can deduct those now. And, you know, tax preparation fees. This is a common question that we get all the time. No longer deductible unless you're self-employed. You might be able to do it. So there you have it. Taxes, you know this, they are complicated, as you know. And the key is to manage your taxes efficiently so that you don't have to pay any more than you have to.